Because I'm always expanding my personal property portfolio, all I really care about are the numbers. And so what I'm looking at is what it's going to cost me per week to own a property right now, and also how much money I'm going to have to spend on the property and where a property market is in its cycle. So right now I've been investing in Christchurch quite heavily, but also I've wanted to get into the Auckland market in a bigger way. So for me, in the last week, I've signed up for 3 properties in Auckland, which are townhouses, and that's because townhouses usually represent quite a reasonable purchase price in Auckland compared to houses, say for example. And then in Christchurch, I bought a higher yielding apartment to kind of combat the contributions that I have to make towards those Auckland townhouses. Let me take you through the 4 properties that I've signed up for in the last week. So I actually bought 2 in one development, which is relatively rare for me to do that. But this is a development of just 16 units. They are 3-bedroom, double bathroom with garage townhouses for $649,000. So very, very low in terms of purchase price compared to the Auckland market as a whole. I like this area because it's a rougher area historically, but you can see a lot of change going on there. And that's because the land's fairly cost effective for developers to buy. And so the end product is quite cost effective, and then the rental covers most of the contribution. Another development that I bought in Auckland is Hull Ave. So this is in Mangere, which again is a relatively lower socio-economic area historically, but it's had some significant capital growth in the last 20 years of about 7.7% on average. So I like that fact. These were 2-bedroom, single bathroom with a toilet separate downstairs, and they come with a car park. So you don't get as much bang for buck for $639,990 as you were for the Butterworth, but it's in an area which is already a bit further ahead with its gentrification. The reason I like the separate toilet downstairs when you're looking at a townhouse configuration like this is because you're probably not for this money going to get 2 bathrooms. So it's great to have a toilet downstairs for guests so they're not traipsing upstairs to use your bathroom. The final one that I want to talk to you about is Y Street. So this is a bit different. So this is an industrial building which is being converted to have residential apartments on the top 2 floors. So I've bought one of the 2-bedroom apartments at a very affordable price point of $440,000. I really like the location of this because it's very close to the CBD in a suburb called Addington, which again has had very good historic capital growth rate and is going through a lot of gentrification as well. With the developers, in the Butterworth development, these are a relatively new developer to me, so I just wanted to know a little bit about what they've done in the past, how long they've been around. I wanted to get an idea of what their financial situation was, and I wanted to make sure that they were going to be able to complete this development. Now, the development is quite far along, and it's completed in only a few months, so I was willing to take a bit more of a punt with this. With Hull Ave, this is a developer that I've known for 10 years. So I know that he delivers a very good, high quality product and has done so over a number of years. Y Street's a little bit different again. Now, this is not something that I would normally recommend to my clients because it's a bit fringy and the developer has a bit more of a checkered reputation of not getting developments finished. But I've taken a bit more of a personal risk on this one just because it's my own investment, not someone else's. The reason it's important to understand a developer's financial position is because if they go under halfway through the build, this could be a major inconvenience, and if you're not structured correctly, you could lose your deposit. Now, the way you would protect your deposit if you're purchasing off the plans is to make sure that the builder doesn't get it until they've completed the project. If they've got access to your deposit, that deposit is at risk. And people who have been investing for a number of years might remember a company called Blue Chip in Auckland prior to the GFC, who were taking very high deposits on apartments there that were being sold off plans, and then when the developer went under, they'd spent the deposits, and so the investors lost their money. You'll see from the numbers that I've used in this cash flow example that the Butterworth Ave investment properties are positively geared by $9 a week. So I don't need to even top these up once I've allowed for vacancy and maintenance, those long-term costs. For Hall Ave, there's a slight top up of $14 per week. And then for Y Street, the Christchurch property, I've been very conservative on the body corporate, allowing for a higher body corporate amount, just in case there is some external maintenance that we need to allow for. But this gives me a $35 a week positive cash flow. So all up, my portfolio nets out at positive $39 per week. So for Auckland, when I've used capital growth expectations, I've worked on a capital growth rate of 6%. And I think based on the location of these units and the price point of them, that's a fair assumption. For Christchurch, I've made it lower. So I've worked on 4% because Christchurch typically won't get as good capital growth rate as Auckland over a long period of time. And I've discounted a little bit further because these are an apartment, so they don't appeal to everyone. I would consider all three of these Auckland properties as growth properties, and I'd consider the Christchurch property as a yield property, again giving me some income to top up any loss that I'm getting in Auckland. Now in this example, I'm using 100% borrowing because I'm using existing equity and existing properties to leverage to buy these. Now, those mortgages are going to be interest only. So I've kept the mortgage balance the same today as it will be in 15 years. Now, if we fast forward 15 years and we use the growth rate of 6% for Auckland, 4% for Christchurch, that's just over $3 million worth of equity that I get for this portfolio that's going to be self-sufficient from a cash flow perspective in just 15 years. All of these examples I've given are brand new properties and off the plans. Now, I think they make a smarter, safer investment due to the predictable nature of the cost. So there's unlikely to be any major unexpected maintenance costs. There's usually a lower vacancy, and they all comply with healthy home standards. What I've found historically is the properties that I have which are newer, better quality homes tend to attract a better, higher caliber of tenant as well. And this is important when I'm building a large portfolio.